What kind of financial return should you expect and demand as an equity crowdfunding investor? That's the million-dollar question. The world of investing is filled with numerous options, each with its own unique blend of risk and reward. On one hand, we have passive public market index funds, offering modest but relatively stable returns. On the other hand, there's the alluring world of equity crowdfunding. Here, the potential for high returns is balanced by the need for active involvement in screening deals. So, if the returns from equity crowdfunding only offer a minor boost compared to index funds, it wouldn't be surprising to find many investors sticking to the familiarity of ETFs and index funds. What's needed is a compelling reason to take on the additional effort and risk associated with equity crowdfunding. Let's dive into some studies to get a clearer picture of the potential returns. Historically, private market studies on angel investors and early-stage VCs suggest early-stage investments have obtained an average of roughly 26% internal rate of return. It's important to note that these early-stage deals typically span a time frame of 5 to 7 years or even more before they exit. Now let's consider Title III equity crowdfunding for non-accredited investors, a regulation that has only been in place since May 2016. When we turn our attention across the pond to the United Kingdom and back stateside to United States Title II accredited investor equity crowdfunding data, we see a range of unrealized internal rate of returns. These figures dance between 17% to a whopping 41%. However, as we cast our gaze into the future of equity crowdfunding returns, the crystal ball is somewhat cloudy. There's still a considerable amount of uncertainty that could impact these returns. There are several differences between early-stage private markets and public stocks. One of the key distinctions is the higher level of risk involved in early-stage investments. A 2007 study by Wilt Bank and Boker found that 52% of investments returned less than the initial investment, while a small 7% reaped returns of over 10 times their original value. This is largely due to the fact that these companies are still in their infancy, often without any established customer base. Another significant difference is liquidity. Unlike public stocks that can be readily bought and sold, early-stage investments are usually highly illiquid. Investors often find their capital tied up for 5 to 7 years, or even longer. Furthermore, deal flow and information asymmetry have traditionally made private markets inaccessible to most investors. However, recent equity crowdfunding legislation is beginning to shift these private market inefficiencies. In summary, past and present data show us that early-stage angel studies yield 17.6%, 37.6% returns, public markets yield 10.2% returns, and Reg D equity crowdfunding yields 17.4%, 41% returns.